Dear investor, in this month of market outlook, we shall be discussing the following topics. 1. Early trends of the Q1 result season. 2. Strong continued inflows into the small and mid cap space from domestic investors. And 3. Time for alpha. And of course, macros and valuations. To start with, Q1 FY24 result season, IT sector as usual has been the first to declare results. While the softness in numbers was expected, the deal momentum was seen strong practically across the board and surprised positively. In some sense, soft future commentary on sales and revenues and good deal momentum seem to be contrary trends. Mostly spends are being controlled on economic slowdown in the West and could move up as economic outlook becomes better. We believe AI is the new focus area. Companies want to be AI ready. This change would mean a lot of work for Indian IT companies over the next few years, maybe next few years starting from Jan of next year. Our focus continues to be the smaller IT companies which are focused on tailwinded verticals like auto tech, telecom technology, travel and leisure, or are getting tailwinds from a region focus, Europe generally seeing better outsourcing versus US as of now, or benefiting from size cohort change. If somebody has moved up the size cohort, they are eligible for larger deals now versus earlier. This space has held up much better compared to the large cap peers. Few banks have also delivered results. While the growth in AUM has sustained for retail banks, there has been a significant NIM compression which was reported. This has occurred, I think, a tad before expectations. And NPAs are also moving up a tad, on cyclical count. Banks have dipped into provisions made during the last few years to report strong profits. The gap in AUM growth between banks with high retail presence and banks with significant corporate book exposure has increased. Going forward, we do believe AUM growth to be driving. In consumers, HUL reported 6.5% revenue growth, of which volume growth was just 3% as pricing-led growth tapered off. Gross margins, however, improved by 279 bips YOY and 137 bips quarter on quarter as input cost remains favorable. Overall, the result season is expected to be strong. While these were early trends, autos, refining, lending spaces, for example, are expected to drive growth in profits. Coming down to the second topic, mid-cap and small-cap funds continue to receive inflows from domestic investors. Indian investors have continued to sustain faith in the equity markets, and inflows into MFs have continued on a trot. We have noticed that inflows reduced during periods of strong market performance and are stronger when the market performance is weaker. Buying on dips seems to be increasingly being adopted by investors. Indian investors in this sense seem to have come of age. FPIs have also continued to buy, and with large institutional classes all buying together, market has continued to remain strong. For 3 months till July 24th, Indian markets have been one of the best performing markets globally. Of the various market cap cohorts, domestic investors have continued to favor the mid and small cap categories. To some extent, it is supported by the long period growth themes that we have been sharing. They are better represented in the mid cap space. However, continuous flow of money into the small and mid cap space has had some effect on valuations. Mid cap, which have on an average traded at a 13% premium to larger caps, are now trading at over 20% premium. However, it is still significantly below the peak seen in the past, and we believe are as yet sustainable. FPI flows have also been positive for the last 5 months and have been very strong over the past 3 months. Insurance flows, though, have been negative and may have aided for some alpha as they are positioned closer to the index. Which brings us to the next topic, that we believe this is time for alpha. We have been saying this for several months now and have shared our thoughts on why this period should be good period for alpha generation. Let us look at developing the same thought differently and try and find right spaces to focus on in a focused high conviction strategy. If correct spaces are identified, alpha creation can then be significant. So let's start with the two large spaces, IT and banks. Banks are 30+% of an index, IT is 11-12% of an index. And it is seen in the past that typically these two spaces don't together perform well. One can visualize this as one space becoming source of money for the other space, which leads to one performing versus both at the same time. It is hence important to have a view on how these spaces would behave as we go forward. The thought is that still capital starved country like ours, both these spaces typically don't work together and money moves from one to the other space. We believe that going forward there could be a situation where for some time neither of the two spaces as represented in the index may do very well. This is in line with the theme that we have shared in the past. Many large banks are seeing change in their leadership and market would want to wait and see how the new leadership performs. So this has been our belief. And hence in the same space, insurance, in the BFSI space for example, we could see better traction from insurance, mutual funds and capital market players, and these spaces may lead performance. Similarly, the larger cap IT names have declared relatively softer results and have indicated continued softness for some more time, and hence here again, if we favor new tech companies and in the services space, mid-cap IT services space, I think relative performances could be better. Mid-cap companies in the IT space have seen many leadership changes, and unlike the banks, the effect here is opposite. The leadership changes here brings with it new business opportunities, which is positive. So that was the thought on the two large spaces. We believe both the larger part of both the large spaces could be the source of money for rest of the same spaces and for rest of the market as well. The other two spaces to compete, for example, are consumers and capex plays. For a long while, particularly in the 2012 to 2021 period, the consumer space performed better than the capex plays. Factors like taper tantrums, bank loss recognition, and ultimately ILFS crisis all contributed towards soaring investment sentiment. Apart from disruptions like COVID and structural reforms which needed time to be digested. In this period, consumers continued to they continued to see business as usual and performed relatively better, and of course market performance followed. However, now with sustained momentum seen in various parts of the capex theme such as housing, private industrial capex, continued government focus on capex, defense indigenization, and overall policy environment, which includes rolling of PLI schemes, the participants of this theme are increasingly drawing attention. In our portfolios, we have chosen to be more with the capex theme over consumer staples. In consumers, we believe the space of luxury consumption and fast fashion could hold out much better on account of higher growth trajectory. Coming down to our next topic, macros and valuations. As we speak, economic activity seems to be sustaining. GST collections for June 23 were up 11.7%, in line with the 3-month trends to around 1.6 trillion rupees. The domestic component of GST was up 18%, pointing to a good strength in the domestic economy. GST collections are a good representation of the health of the economy. You pay taxes only when goods get produced and sold. The central government fiscal data for May 23 also shows a sustained capex push, with capital spending up 68% in April-May period, and road and rail spending also staying strongly up with 54% growth on Y2D. In this pre-election fiscal, the government could accelerate spends to keep the growth momentum strong, bringing in cheer to the masses. Forex reserves happily have continued to be buoyant, and after a long while have crossed the 600 billion mark. This should result in continued policy freedom for our central bank. And if our thesis is right, while the West may increase interest rates over the next period, we should see RBI probably staying put, and that we don't see further rate increases. The opposite could happen if we see a sharp decline in Forex. This is because we are a country with large unemployment, and growth is an imperative. This is very different versus the West, which has close to 100% employment. On valuations, we have been sharing our construct as 18 to 18.5 time 1 year forward earnings. On a financial 25 Nifty earning expectation of around 1100, if we apply the top end of this range, we get a target of 20,350 kind of levels. From where we are, this is just about 3% away. As we have noted earlier, the mid-cap space is valued relatively to large-cap space in line with long period average, and hence with this reality, one should expect a period of consolidation in the market. A quarter of consolidation corrects valuation by 3 to 4%, given a 12 to 16% compounding expectations of the index earnings. At the current juncture, given the taxation structure, the hurdle for equity returns for HNIs to opt for equity over debt is around 5.5 to 5.75%. And hence, if we get a period of consolidation of say a quarter, 4 months, or a drop in the market of around 5%, we do expect sizably flows, stronger domestic flows into equities. This has happened in the past when we have seen a trend of stronger flows when markets dip, and it could continue. We believe that since the growth themes such as hospitals in healthcare, chemicals as China Plus One, and EMS again in the same theme, defense, indigenization, engineering, new tech, second rung tech companies, retail focused bank, etc., are best represented in the mid part of the market. This is the part to continue to focus on for investing and alpha. So our funds are positioned similarly. With this, thank you investors, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.